Thank you, Mr. Chairman. I want to start by welcoming Wally Adeyemo. Wally and I worked closely together when I was helping set up the new consumer agency, and as he testified, he was the agency's first chief of staff. I don't say this lightly. Wally is a miracle worker. He works hard, he's smart, he manages people and projects with amazing skill, and he understands policy all the way down. And here's one other thing. I want to make sure everybody on this committee knows. Everyone who works with Wally likes him. Republicans and Democrats, everyone. Inspectors General, Secretary Geithner, Secretary Liu, me. He really is a remarkable guy. I didn't have anything to do with Wally getting this nomination. In fact, I'm sorry, Wally, I just didn't know. I didn't know until I got the call from the FBI background checkers that he had been nominated or was about to be nominated, but he is a great choice. Wally knows where he came from. He remembers who he grew up with, and he tries every day to make this a better country. So I hope that everyone on this committee will support him and that he gets an up or down vote from the Senate very quickly. We are lucky to have him in service. And I want to thank all of you for being here today, and thank you for your service. I just have one question I'll focus on in the time I have left, and that is a question around systemic risk. Mr. Gerety, as you know, in Dodd-Frank, Congress directed the Fed to impose tougher standards on banks that have more than $50 billion in total assets. That covers about 40 of the biggest banks in the country, about 0.5% of the 6,500 banks that we have in the U.S., but about 95% of all the banking assets in the United States. Now, this tougher scrutiny is designed to focus the attention of the regulators on where the risk is, not on community banks or credit unions, but on the biggest banks that can threaten our financial security. Of course, among these 40 biggest banks, some are riskier than others, and Congress knew that. So it directed the Fed to tailor its rules to match the risk that a particular bank poses. There's been some talk recently about exempting many of these banks from the tougher rules that are imposed on banks with $50 billion or more above that threshold. And it's talk about increasing the threshold to as much as $500 billion. So what I want to ask Mr. Gerety is, as Acting Assistant Treasury Secretary for Financial Institutions, you've gotten a close look at the risks posed by banks of different sizes. Based on that experience, do you think it makes sense to exempt banks with up to $500 billion in assets from heightened standards in Dodd-Frank, rather than just directing the Fed to tailor the rules appropriately for riskier and somewhat less riskier banks?
Thank you, Senator. I think you raise an important principle at the heart of our approach in financial supervision, which is that the toughest standards should be applied and the highest scrutiny should be applied to the largest and most complex financial institutions. As the Secretary has said, raising the number that high raises significant concerns. It would leave only a handful of firms subject to the statutory enhanced prudential standards, and raises the risk that firms that we saw in the crisis, Countrywide, Washington Mutual, Bear Stearns, which were significantly below that threshold, also demonstrated that they could pose risks to the system more broadly. I think the central question for us is, how do we make sure that the tailoring is appropriate? It's very clear that a $50 billion institution is different than a $2 trillion institution, and also that it's different than a $2 billion institution. I think that we've seen the Federal Reserve and the banking regulators look at ways to design different standards even above $50 billion, but I know that we continue to hear concerns from firms, particularly at the lower end of that threshold, and I think there's always continued dialogue that would be very valuable to make sure that those standards are appropriately tailored and that they appropriately capture the risk that may exist within a range of financial institutions in our country.
All right. Thank you very much, Mr. Gerety. To me, this is an easy decision. We can raise the threshold and cut loose half or more of the biggest banks in the country and just hope they don't make the same mistakes that they made in 2008 when they nearly brought down the whole economy and had to be bailed out. or we can play it safe, keep the threshold where it is, and rely on the Fed to follow the law and tailor the regulations to the risks that are posed by different large financial institutions. Since the American taxpayers are on the hook when the economy starts to implode, I suspect that most of them would prefer that Congress play it safe here. Thank you. Thank you, Mr. Chairman.